Special thanks to, okay, a very, very good friend of mine just joined, Srini from the US. Welcome, Srini. I was just giving them a ramble about our IMRs in the past and 5 years back, etc., etc. So you haven't missed anything. Great to have you on the session. Wonderful you could make the time to join. Thank you. Right. So, okay. So since, okay, what you were supposed to see is all this colorful stuff, which you guys did not, right? So what I was saying is that for most of you, all this might be a little overwhelming. You may not have seen stuff like this before. You may not have seen all these, colors and charts and lines and numbers and all those things. It's okay, chill. All right. Like I said, today is a restart after a very, very long time. And I myself am probably rusty. Right. So don't worry about getting overwhelmed. What I will do is narrate the story that is there on the chart, and then you just take it from there as to how it goes, right? So this is just to give you a sense of one way. It's not the only way, and it's not necessarily the best way, but it is an effective way in which retail investors like you and I, traders, can find opportunities and just go with the flow. It's fine. Like I said, if you don't really understand a lot, maybe we'll see what we can do about that in the future, right? So with that, let me jump in. And what I'm going to do is start with the global markets and then drive down. So like I said in the chat box, global markets, maybe some India stuff, Forex, and if there's time, some cryptos, right? So as usual, the usual drama that all of us with Zoom have. This is not a paid account, so it'll close in some, I don't know, half an hour. And I think Zoom has now introduced something where you need have a 5-minute break before you can start again. So probably this will go on for an hour or so. I'll try and keep it as crisp as possible. But when this link time gets over, then just log in again with that link that I've sent you all, and then we'll just continue with the second part. All right. So let me start with the US. And what you see here, by the way, just to confirm again, everybody should be able to see my charts, my screen, and hear me clearly, right? So if anything is not working for you, then please let us know so that we can fix that, right? Okay.
Able to hear you, Musa.
Hey, Srini, thanks. Okay, great. What time is it there?
10:50 morning.
Okay, fine. Cool. So Srini is in the US, by the way, a very good friend of mine, been around, okay, let me not take that time. So S&P 500, the S&P, the Standard & Poor's 500 index, which has 500 stocks from the US. And what you're seeing is a monthly chart of this index, and you're seeing it from 1998 onwards. Let me just make it only a price chart. And you see these various lines, these yellow lines, blue lines, and green lines. These are all certain levels that are important to that index, which have been marked. So these are things that some of us do on a regular basis. So just to get a sense of where we are now, this fall that you see from about 3,400 to 2,200 on this index was the fall because of COVID, all within a matter of 2.5 months. And then, sorry, 2 and 2, yes, right, monthly chart. And then the recovery started, and who would have thought that the index, the US, and this is by default in a sense, you can get it. So why we do the US, by the way, is that US is the absolute biggest market by far, and it generally sets the trend for all the other equity markets in the world, right? So that's the main reason why we look at the US markets. And like I said, the other reason now I look at the US markets for more than a year now is because I'm investing in the US markets along with friends of mine like Srini and others, right? So yeah, so the index fell from 3,300, which was a lifetime high at that time, to 2,100. So almost about a 30-35% fall in about 2-3 months, right? And this is the overall index. So when the overall index falls, whatever, individual stocks will fall often much more and some less, the really good ones. And while in the middle of the pandemic, while all this all hell rose, broke loose, then we started a recovery, and then the market came back to its place in about a year's time, its previous high. And then who would have thought that it would go, just higher and higher from 3,300 to 4,800, right? Which is a pretty significant, rise if you really think about it. After that, we've corrected. It came back to a certain support level of 3,600. And then if I go to the weekly chart, you will see the same chart, but this is a weekly chart, and the market has sort of what we call bottomed out and has started to rise again. Now, at this point, there is no definitive indication on the chart, on the US chart, or any chart for that matter, except there's one country which I'll talk about later, that the uh, the fall is definitively over. This, what you see happening here, could just be a bounce, and then we could still come back down. And remember, this year supposed to be the recession. You're having a lot of firing going on, jobs being lost, etc. So we'll have to see what this happens, and this is going to be a very interesting year. The other thing to keep in mind is that 2024 is not the India election, but the US elections. And that that generally tends to have a bearing on global markets. And of course, the India elections will have some bearing on the India markets. And so this year is going to be a very interesting year with a lot of global events, a possible global recession. Some people talking about a bad one, some people talking about a soft recession. And then we're talking about inflation. That's another story that we will discuss in future webinars. And then there is the elections, two big elections that are there, the Indian election and the US elections. So the next 12 to 15, 18 months is going to be most interesting, with a lot of action that is going to happen in the market. So for those of us who are going to be actively tracking the markets and following the markets globally, especially, I promise you there'll be plenty of action and there'll be plenty of opportunities, right? Okay, so like I said, the US market sort of looking at, attempting to go back. And if I come now to the daily charts, right? So what's happening is that you are seeing what we call a tentative uptrend. Okay, and a tentative uptrend is something where you get a higher bottom. So this is what we call a higher bottom, this line that I've just drawn. And maybe I'll just put it a different color for everybody's benefit. What should that be? Okay. Nah, this will just keep it as yellow, right? What we don't have is a higher top. For those of you who know about, market basics, higher tops, higher bottoms, we do not have that yet in the US market. And as of now, the US market is live. So what you're seeing here is live data, by the way. 0.85% down, which is nothing big. But what is significant is that it has crossed major what are called long-term moving averages, the 50-day, 100-day, and the 200-day moving average, which is a bullish sign, all said and done. And we'll see, how this goes. So there are analysts who would perhaps now start to think that the US market has turned bullish, right? And this will have a bearing, like I said, on the rest of the world. So very quickly looking now at the Dow Jones index. Some of you will be familiar with that also. So the Dow Jones is another index in the US, right? So this, on the top left, you are seeing the monthly chart. Bottom left, you are seeing the weekly chart. And the right panel is the daily chart, right? So just to give you some orientation. So the Dow Jones also more or less exactly the same situation as the S&P 500. So the broad market, the S&P 500, the Dow Jones has only 30 stocks in it, and that's also more or less a similar picture. The technology heavy index, which is the NASDAQ, right? Also more or less the same thing, except that one could argue that the NASDAQ hasn't really broken past the 200-day moving average like the S&P 500 has. So a little bit of a lag, but all said and done, individual IT stocks in the US have actually started to do really, really, really well, right? Okay. Then looking at the Russell, this is the Russell index, which is a very, very large index of 2,000 stocks in the US, which has actually done on a relative basis, probably perform the best. Okay. And you actually have a higher top, higher bottom in the Russell 2000. So especially for, I think, Srini, myself, and anybody else who's looking at global markets, this is something, significant. So the broad market in the US very tentatively, okay, has a higher top, higher bottom, which the other major indices do not, right? Okay. Looks like quite a few people losing their internet connection and rejoining. All right. So this is something to keep in mind. So perhaps, the broader market in the US is actually doing better than the specific large stocks that we generally look at. And so this is, by the way, how one starts to drill down and, sort of get a sense of where the opportunities are and where one should be looking, where one should perhaps not look, right? That which is a significant advantage. So the take home from this very quick review of the US indices is that the broad US index, the Russell 2000, is actually doing way better from a low to top basis, simply because it's got a higher top, higher bottom, and crossed all the large moving averages much better, or at least slightly better than the other main indices, right? So that's something to keep in mind. Very quickly looking at some other indices, now coming to Europe, right? So this is the DAX, which is the main index of Germany. And look at what's happening here. The German index has done way better than the US index, right? You can see this on any panel, especially those of you know technical analysis and look at charts, can see that the rise from this place. Okay, let me just even look at the monthly index, right? This fall and this rise way better than what you saw on the S&P 500. So let me just go back to the S&P 500 so that you get a sense of it. So this is the S&P 500, right? This is what the S&P 500 has done, right? Still sticking at the downtrend line, hasn't really broken out to it, right? Likely to, but a little iffy right now. But you look at the DAX, and where is that? Yeah, the German index, and you can clearly see that it has done much better and outperformed the US indices. So if you were a global investor, so here's a take home for you immediately, that you should have been, or you should even now be looking at the German stocks and the German listed companies rather than the American listed companies to outperform your portfolio, right? So this is a live example of how one can really okay, look at the CAC. This is the French index, all right? And all these are in euro denominated, remember that, right? So it doesn't really matter. So you're talking about US dollars on the one hand and euro on the other hand. So you can look at the CAC. CAC is almost coming back to its life high and has done even better than the DAX, which is German, right? And if you look at the UK, well, surprise, surprise, that UK is actually, okay, this is actually not the best chart for the FTSE 100. I will come back to the reasons because the history is not there long enough, right? But on the fact that it has come back to this green line, a sort of it's not a really lifetime high. That's why I said this index is not really good. But just to give you a sense of how the European markets are actually doing way better than the American markets. Of course, the UK has a specific issue, which is the UK pound and the nonsense that happened with Prime Minister Truss, right? She and her finance minister who just did some nonsense, and the pound got devalued. And actually, a result of the devaluation, of course, the UK market fell, but you also had a re-rating of the asset values that happens when currencies fall. Let me not get too involved in that, but that's one of the reasons why the FTSE has done better. Apparently better. You would have lost out on the foreign exchange conversion, right? But leaving all those complications aside, the DAX and the CAC with the euro, those are the game. That's the game to be in, right? To look at other parts of the world so that we get a sense of where we are, generally speaking. Right. So this is the Canadian index, the Toronto Stock Exchange, TSX, and that's also done pretty good, right? So I'm just extending this trend line on the monthly chart, and then it'll affect everything everywhere else. And this has got a really nice higher top, higher bottom. Right. So the Toronto index also doing well. Then you have the Nikkei, right? So the Nikkei is a Japanese index. All of us know, especially done the courses, know the sad story of the Nikkei, right? Just since there are so many new folks here, just to point out that story about the Nikkei is that the Nikkei index topped out in 1989. Okay, that peak, that green line that you see there is 1989, right? We are what, 32 years from that, and that index is still, all right, about 30% below 1989. And you add inflation to this, you would have lost a hell of a lot of money if you had bought into the Nikkei or the Japanese index at this time. And 30 years later, that's a whole generation, mind you. If you're in your 30s, you're in your 60s right now. If you're in your 50s, well, you're either dead or you're in your 80s and 90s and still looking at, recovering your money. So this thing that, markets are all rosy and only go up is a myth, right? They go up, they go down, and the important thing is that you need to know when to be in and you need to know when to be out, right? Long-term investing is a widely touted mantra for the masses. I can't get into the details in today's session, but trust me, I can show you data after data that long-term investing is not really something that works, especially probably after 2000, 2008 for sure, where this massive quantitative easing or printing of currency has just gone right, left, and center across the world. And in terms of purchasing power, you would have been left way behind. So this is a lesson. And remember, the Japanese economy, sorry, second or third largest economy in the world. And that's the situation here. There are lessons for the rest of the world and for all investors and traders to take from this in terms of your own wealth creation over your lifetime. Those lessons more to be discussed in some other session, right? Okay, so this is the Shanghai index, China, right? So again, you can see that, the Chinese index topped out in, I don't know why this is not marked. Okay. Yeah. Okay. Chinese index topped out in 2008, and that was at 66,100. We are at 3,200. So 50% down on the Chinese index even after 30 years. I mean, that's ridiculous. It's just ridiculously crazy that after 50 years, and you've had this big, massive swings from 2,000 to 5,000 and down. So, from 5,000, if you came down to 2,500, you lost 50% on that. That's the overall index losing 50%, right? So again, lessons to be had and to be, learned, and then we'll see about, how that goes. Okay. Yeah. Okay. Why is the reset not happening? 1 second. Okay. All right. We have, okay, 3 minutes before this Zoom session ends. So let me finish, yeah, two very quickly, and then you can rejoin back with the same link. All right. So what is, why this is an index that, you should again be paying attention to. And this is something that some of us did discuss or in some of the private chats that we've had. Okay. Let me just give you a sense of what happened. So while the world was, busy looking at China and COVID and saying this happened, that happened, they did this, they did that. Look at what happened to the Hong Kong index. This is the Hong Kong index that you're seeing. So the uh, right panel that you see, say 15,000. From 15,000, it went 22,000 in from November last year to now. Okay, so that's November. Okay, November, December, January, 3 months, right? That the, okay, internet is slow. All right, I hope you can see the HSI. Okay, that's November, from November at around 15,000 to 22,000. Now, just to make that, how much is that? 7,000 divided by, if that's, no, yeah, that's a 46% gain in one of the world's most important equity markets, right? So while you and I were sleeping and talking about all sorts of things, maybe you're bothered about politics in India, or you're talking about the Ukraine war, or you were busy with, I don't know, Trump's comeback or the climate change and all. There was this one index which went up 46% in 3 months. And when you're talking about a large equity index, that too of Hong Kong, no small feat, that's a huge wealth creation thing, right? Now, the thing is that what most people also forgot is that Hong Kong topped out in 2018, right? And then went sideways till about 2021, right? Even during the, the midst of COVID, it didn't really crash. But then after Xi Jinping wanted to clamp down on Hong Kong and brought down those, whatever controls, constraints, stop the politics and all, the Hong Kong index went down from 28,000 to 14,000, 15,000, and everybody forgot about it. And then Hong Kong bounced back. Those things were loosened up, and now you have free travel. COVID is not an issue. You don't need a COVID certificate. You don't need a COVID vaccination to go to travel to Hong Kong. And even before all that was announced, the market had gone up 46%. Lessons to learn in wealth creation when you go across the world. All right. So this session is going to stop. And then in the next session, we'll start looking at the India markets, right? So let me end the session and